All right, Canada, strap in. I'm about to say something deeply unpopular, maybe even offensive, but definitely necessary. You're not getting the expected interest rate cuts anytime soon. Nope. Relief is not around the corner. The cavalry isn't coming. And if you're sitting on a mountain of variable rate debt, HELOCs, credit card balances, and praying for a 2008 style central bank pivot, you might want to pour yourself a stiff drink and start budgeting like it's 1994. Let's start with the data, because unlike government spin, the numbers don't lie. The July 2025 Edge Analytics report delivered the economic equivalent of a punch in the gut for borrowers when I read it. Why? Because it confirmed that Canada's jobs market is still stubbornly strong. StatsCan says we added 48,000 jobs last month, albeit most likely summer job hires. That's not cooling inflation. That's pouring lighter fluid on it. And remember, the Bank of Canada isn't your friend. It's not there to make your mortgage payment feel easier. Its sole mandate is price stability. And when the job market runs hot, like it did in the last report, wage pressure follows. And when wages rise, what follows? Ding, ding, ding. Inflation. Look, I get it. The narrative felt good. Inflation was slowly drifting down, bond markets were whispering, pivot, and everyone and their dog was locking in 120-day rate holds. But here's the problem. Inflation is sticky. Service inflation is not going anywhere. Oil prices back on the rise. Mortgage payments still going up at renewals. Food, let's just say your grocery bill could double as a car lease payment. The last Bank of Canada meeting that gave us a cut was March 12th, the seventh in a row at the time. But the next one, don't hold your breath. Here's a little forecast for free. If job creation remains positive and core inflation holds, you can forget rate cuts until early 2026, maybe longer. Now let's talk impact. Let's talk about the real pain on the street, the kind your neighbors feel, not the Bay Street suits. If you're a Canadian homeowner with a variable rate mortgage, a HELOC tied to prime, a renewal coming up in the next 6 to 12 months, you are in the pressure cooker. And that steam, it's getting hotter. Impact number one, renewals at brutal new rates. If your 5-year fix is maturing, you're going from 189 to 4.39 plus. On a $600K mortgage, that's about $1,250 a month extra in interest alone. That's not a pinch, that's a chokehold. Impact number two, the HELOC trap. A lot of Canadians dipped into their home equity over the last 3 years, but now that retail prime is hovering around 495 and staying there, your interest-only payments are eating your budget like termites in drywall. Impact three, the private mortgage ticking time bomb. Edge Analytics highlights this beautifully. In Toronto alone, almost 40% of recent refinances were in the private or alternative space. Shorter terms, higher rates, and very little runway. Impact number four, consumer credit stress. TransUnion, one of the 2 credit bureau agencies out there, latest numbers show that delinquency rates are rising across the board. And guess where it's hitting the hardest? Ontario. Why? Because we carry the biggest mortgages and the smallest margins for error. Let's be clear. Bank of Canada Governor Tiff Macklin, hands are tied. He can't slash rates aggressively because the US Fed is staying firm. If we drop too fast, the loonie tanks. Wage inflation is sticky. Services inflation remains stubborn. And brace yourself. Canada's population is still growing, just more slowly, keeping pressure on housing and spending. It's a catch-22 situation. We want price stability. We also want rate relief. And we can't have both. So what do policymakers do? They wait. And while they wait, Unfortunately, you bleed. Let me give you a no bullshit preview. Renewals will spike at rates 2 to 2.5 times what people originally signed for 5 years ago. Affordability will continue to erode, especially for families with kids in daycare, sports, or post-secondary education. Foreclosures? Not en masse yet, but forced sales are happening quietly. I see it every day. Expect more. Consumer spending? It's going to crater. And when it does, so does small business revenue. Mental health and financial stress at all-time highs. So be kind to those around you. You just don't know what they're going through. So give them a hug. And what's worse, most Canadians have no plan. They're still pretending this is temporary. It's not. It's a recalibration. So what do you do if you're a homeowner? Book your mortgage review now. Don't wait for the bank's auto renewal letter. That's financial malpractice. Stress test yourself. Rework your budget assuming today's rates last 3 more years. Can you survive? Consider locking in strategically, but don't just fix it and forget it. Think short term, 1 to 3 years, fixed. Flexibility is power. Reduce bad debt. Your line of credit isn't your emergency fund. Kill that balance now if you can. Look at reverse mortgages, adding an income suite if you can, or downsizing, especially if you're over 55 and sitting on equity, but drowning in expenses. Put yourself in a better situation. I'll leave you with this. We've spent years borrowing like rates would stay low forever. Now, the piper's here and he's charging higher interest rates. The Bank of Canada is not here to rescue you. Be sure about that. It's not a lifeguard. It simply regulates. And its job is to cool inflation, even if that means freezing you out. So get serious, get educated, get help. And if you need guidance, we're here. OwlMortgage.ca. Real talk, real planning, and real solutions. If this hits a nerve, good. It means you're paying attention. Like, subscribe, drop your comments below, and book your mortgage strategy session with OwlMortgage.ca today. Because the next 12 months, they're not about rate relief. They're about survival. I'm Vince Gaetano. Thanks for listening. And remember, the wise old owl is here to help you navigate through the noise and provide insight to the financial chaos in the current environment. Stay informed, stay vigilant, and together, let's chart a path to financial stability. Cheers.